Bernard Delbecq. I am the head of research at EFAMA. And it is my pleasure to welcome you today to this webinar, where we will present the 16th edition of EFAMA Asset Management Report. The AMR offers a comprehensive analysis of the current state and trends in the European asset management industry. And before diving into the details, I would like just to briefly highlight two key distinctions between the AMR, as we like to call the Asset Management Report, and the other EFAMA publications, such as the fact book, the fact sheets, and the quarterly statistical release. So first, the AMR focuses on where assets are physically managed in Europe. And secondly, it distinguishes between two types of investment vehicles. First, investment funds, UCITS and AIFs, and discretionary mandates, which are investment mandates delegated by specific investors, typically institutional investors, to asset managers. So, in a sense, while our other publication, and I think many of you are familiar with the fact book and the fact sheet, primarily concentrates on UCITS and AIFs and where those funds are being domiciled, the AMR takes a broader view. It is published once a year in December, and it focuses on both funds and mandates and analyze where assets are managed in Europe, in which countries, what is the client base of our industry, and what is the asset allocation of investment funds and mandates. To present the main findings of this year's report, my colleagues from the research team have prepared a set of slides. Thomas Tilley will start the presentation, and it will be followed by Vera Jotanovic and Eileen Young. If you have any questions during the webinar, I kindly ask you to use the chat function at the bottom of the screen, and I will address them to my team during the Q&A session following the presentation. So it is now my pleasure to give the floor to Thomas. Thomas.
Thanks a lot, Bernard. Thanks for those that good introduction. So the AMR, Bernard covered most of it indeed. So the main focus here is where in Europe assets are managed. The data was provided by 21 national associations of EFAMA. And what also makes this publication unique is that we have different perspectives from other industry players. Namely, now we have a perspective from McKinsey, Oliver Wyman, and Novantigo on retail and longevity opportunities for asset managers and the demand for from European insurers for private assets. Every year we try to innovate a bit. These are sort of the new bits we put in this year in this report. But let's dive into the first section, assets under management in Europe. So 2023 was a good year for the industry. So the main focus of the report will be on what happened in 2023 with some projections, because we don't have the data yet of what is happening so far in 2024. We had a growth of about 8%, 8.3%, mainly due to the good performance of stock and bond valuations. This was followed after, of course, the difficult year 2022, when we had a 14% drop in AUM. Because of the war in Ukraine and the steep rise in inflation, which of course had a negative impact on bond valuations. And here on the right hand side, you see sort of an indication of bond prices, here shown by the Euro Stock equity index, and bond prices here shown by MSCI Eurozone Government Bond Index. And yeah, you see here these steep drops in 2022, which resulted in this steep drop here. And then the recovery in 23, solid recovery. And so far also recovery in 2024, we're seeing in the first 3 quarters. A lot better recovery in the stock markets than in the bond valuations. So we project at the end of September that assets in Europe will be at around 32.7 trillion. That means that by the end of this year, we will be at least at about 33 trillion. So as Bernard mentioned, we are focusing on 2 different assets of the asset management industry, namely investment funds and discretionary mandates. Sometimes the line between these 2 is a bit unclear, especially when you have these bigger funds you produce for you make for institutional investors. Then it really depends sometimes on country preferences. For example, in Germany, they rely a lot on these alternative investment funds, these special funds for alternative investors. Whereas in Italy, for example, the market focuses for institutional investors focuses a lot on discretionary mandates. The same in the UK. So at the moment, if we break down AUM, we have about 33% mandates, 57% in funds. These are the evolutions over the past 10 years. And there has actually been a steady rise in funds and a steady decline in mandates. This is, of course, in market share. So in total, AUM has increased for both of these instruments. But why have funds grown more? Because they have a higher percentage of equity in their portfolio allocation compared to mandates. That is because mandates are more focused on institutional clients, and they tend to prefer bonds. And of course, since stock markets did very well over the last years, this sort of pushed the market share of funds up. Especially this strong rise in 2021 here was due to the excellent performance of stock markets. So this year we have a very small increase in the market share of funds, 0.3 percentage points, and this is also to do with sort of the slightly stronger increase in stock markets than in bond markets, and the higher proportion allocated to equity. What are the biggest countries in terms of where funds are managed? It's a very concentrated market in Europe. We have the UK at the 28% market share, followed by France 19, Germany 14, Switzerland 11, and then the Netherlands and Italy, and then Spain here at about 2%. How have these market shares shifted over the past 5 years? So here we show the trends here for the top 6 players in Europe. UK has increased their market share by about 1%, and it has also increased a fair bit in Switzerland. Whereas in the Netherlands, it's actually increased by 1.7%, and this is due to a shift we've seen in the regulation. So what you had in the Netherlands with their big pension fund market, they had AIF wrappers for pension funds. So a whole pension fund was wrapped in an AIF, an alternative investment fund. Due to the new IFR IRD prudential rules, it's actually more advantageous to have this in a mandate. So we actually here have a big shift from funds to mandates due to the shift in regulation we've seen in the Netherlands. What we also felt was interesting to point out is that country of management, like we show here, and the main focus of the what is the main focus of the report is only one way of looking at the fund market in Europe. So here you have the net assets by country of management for all European countries for which we have data and their market share. There are a few for which we don't have data, so there we make an estimated total. But it's one way of looking at the figures. Like the other way of looking at figures is look at the funds by country of the fund domiciliation. This is the perspective we mainly take in the fact book and the quarterly and monthly publications. A third way of looking at funds is by the fund ownership, like who owns the funds in Europe. And that data we source from the ECB, and it's also included in our fact book. And you see here the top positions are quite different. So looking at management, it's mainly the UK, followed by France, and then Germany. Whereas if we look at country of domiciliation, Luxembourg has about almost 26% of the full fund market, then followed by Ireland at 20%, and then Germany at 13%. Looking at fund ownership, it's really German investors who own more than 20% of the fund market, and then followed here by the UK at 13.8%, and then France. So it's really, all of these views are actually complementary. And if you compare here, you can see sort of where the focus of in most countries, like the mid-sized markets like Austria and Belgium, they have like fairly similar amounts of managed and domiciled, but they have a higher share of fund ownership in proportion. And that is because the international funds and distributed cross-border in Europe are mainly domiciled in Ireland and Luxembourg. So you see that here for Belgium also, 1.4% market share in fund management, 1% in domiciliation, but 2.8% in fund ownership. The same for Italy, for example, 3% in managed, about 2% in domiciliation, but almost 7% in fund ownership. A lot of it is depending, of course, in how the fund market is structured, how the asset managers also structure their funds. In some countries, they tend to keep the domiciliation domestic more. In other countries, like Italy is a big example there, where they have a lot of funds distributed in Italy or domiciled outside of Italy. Shifting back to the other side, the mandate side, this is again where these assets are managed. So where discretionary mandates are managed, this market is even more concentrated. With the UK has about 5.7 trillion of AUM in mandates managed in the UK, 45% market share, then followed by France, Switzerland, Netherlands, Italy, and Germany. Here, there is sort of a decrease of the two biggest markets in terms of market share, of course. And we see rises in Switzerland. Here, the Netherlands, this 5% is the reverse side of the coin of what I explained earlier with the decrease in funds. So funds wrappers that are being converted into mandates. And the rest to Italy has been relatively stable, and Germany here has increased a bit. So that was an overview of how AUM have shifted. Now it's over to Vera for sort of the role asset managers play in the economy and in society.
Thank you, Thomas. Hello, everyone. I will be presenting the role of asset managers and their particular role in financing the European economy. First of all, a few words about the role of asset managers and who we are as an industry. We act primarily as agents managing assets on behalf of clients. In that sense, we hold a crucial role in the financial ecosystem. Now, first of all, we provide risk-adjusted returns for the clients, meaning we maximize the returns, but take into account the risk that it brings by many strategies such as diversification and so on, in order to decrease the risks that our clients can entail. We reduce transaction costs by investing big blocks of securities for our clients. And while we invest in companies, we are also actually able to better the governance of these companies through different strategies such as engagement with the board members or the management of the companies, or voting at the annual general meetings. Now, a key role would be the financing of the European economy. The industry finances the European economy by generating savings from our clients and efficiently directing it to companies and government projects, for example. Why is this important? It's increasingly important in the age where Europe is losing its competitiveness edge and where it needs to generate more private capital to direct it towards efficient projects in financing the investments, but as well the two transitions, realizing the two transitions such as the digital and the green transition. Therefore, European asset managers are currently representing a crucial role in the European financial ecosystem. This section that I will present today will actually tackle upon the financing of the European economy through two major asset classes, which are the debt securities and listed shares. First of all, I'm going to be talking about the debt securities owned by the Euro area investment funds. On the left-hand side chart, you can see the total amount of debt securities owned by the Euro area investment funds, but issued in the Euro area in green and the rest of the world in purple. On the right-hand side charts, you can see those respective shares, where slowly through the years from 2014 to 2023, you can see the changes in trends of the holdings of debt securities issued in the Euro area and elsewhere. Starting somewhere in 2017, the shares of debt securities issued elsewhere, not in the Eurozone, by the Euro area investment funds have been higher than the shares of debt securities issued in the Euro area. This trend has persisted until 2022, when the reverse trend has taken place, where at the end of 2023, those two shares were almost equal, with in total amounts roughly 3.2 trillions of debt securities were held by Euro area investment funds, both issued in the Euro area and in the rest of the world. Now, when we look at the flows, net flows of net purchases and net sales of debt securities by the Euro area investment funds, they followed the story that we see in these outstanding amounts currently seen on the slides. Now, until 2022, we have a net purchase of debt securities issued outside of the Euro area. In 2022, there's a net purchase of debt securities issued in the Euro area and net sales of debt securities issued outside of the Euro area. And in 2023, it's almost somewhere equal, positive net purchases of both. Now, why did this happen? One of the explanations could be the change in interest rates, and where in 2022 the interest rates actually grew, so investors went back to investing in debt securities issued in the Euro area. But it remains to be seen what will happen in the future with the changing macroeconomic landscape. When it comes to the listed shares, the story is a bit different. Here we see a consistent increase in shares of listed shares issued outside of the Euro area, but owned by the Euro area investment funds. Similarly, as the previous slide, on the left side, you will see the outstanding amounts of listed shares held by Euro area investment funds. and issued in the euro area in green and in the rest of the world in violet. And on the right-hand side, you will see their respective shares. We see a consistent increase in listed shares held issued outside of the euro area, and a consistent, therefore, decrease of holdings of listed shares issued in the euro area. The flows also follow this story, where we see a consistent net purchase of listed shares issued outside of the euro area by the euro area investment funds. Now, what's the story behind this investment of listed shares issued in the euro area? It could be in the popularity of the global equity funds that are highly invested in equities outside of the euro area, such as in the US, particularly a very big famous tech equity that simply generate better returns. This could be one of the explanations why we're seeing these numbers on the screen. At the end of 2023, therefore, we had around roughly 1.4 trillion of listed shares issued in the euro area and owned by the euro area investment funds versus 3.7 trillion of those issued outside of the euro area. Now, we have expanded this analysis not to rely only on the euro area investment funds. Therefore, we have also included investment funds outside of the euro area, so in the EU and UK. And also we have expanded our analysis to include the discretionary mandates. Once this analysis has been performed, we came to the following encouraging numbers, that 6.4 trillion of EU issued debt was actually held by European asset managers, as well as 3 trillion of EU issued listed shares has been held by European asset managers at the end of 2023. This corresponded to almost 1/3 of the total issuance in the EU for both, respectively, 28% of total debt securities issued in the EU and 27% of total listed shares issued in the EU. Now, this is a very let's say, a picture of financing of European asset managers towards the European economy, but it represents actually the minimal level, because the debt securities and listed shares are only 2 asset classes of all the asset classes held in the portfolio of European asset managers, where we have around 26% of the portfolio attributed to other asset classes, which my colleagues will follow up in the continuation of this presentation. Thomas.
Yes, but first we're going to have a look at the clients of the European asset management industry. Europe is still an institutional market. This is really different, where we're really different from the US. About 69% of assets managed by European asset managers are managed on behalf of institutional clients. Only 31 are managed on behalf of retail clients. Amongst these institutional clients, the biggest clients are pension funds. You have then also insurance companies, what we call other institutionals, which is sort of this mixed group of sovereign wealth funds, holding companies, corporations, charities, foundations. And then banks also are a client, but a smaller one, except for in Switzerland. But despite the fact that institutional clients are still the main client, retail clients have actually grown in importance. In percentage points, they grew by 1.3 percentage point, and they've seen their share of AUM increase in recent years. And this is shown quite clearly here, which shows AUM growth by client type, where we had in 19 still institutional clients growing stronger than retail clients. This was about even in 2020, where we had lower growth with the COVID pandemic. But from 2021, growth has actually been consistently higher amongst retail clients. We had, and this year, 2023, we actually had more than double the growth numbers in the retail markets than in the institutional market. So what's happening there? One trigger in 2020 was the lockdown measures, which sort of gave more time to a lot of people that they weren't working, or they were working from home, so they had time to consider their investments. And there was also a lot of disposable income they couldn't spend on travel, on restaurants, so they started investing. Another trigger was 2022 with the spike in inflation, which sort of meant that on your money was losing purchasing power very quickly on your bank accounts. And a lot of European banks were very slow to raise interest rates. So investors were really discovering the markets. In 2023, this continued. And we've been also seeing this in the inflow, the actual inflows by households, by retail investors into funds. Even though I have to say in 2023, the inflows was slightly lower than in 2022, and that's because in some countries retail investors shifted towards direct debt securities. You had very successful government debt issuances in Belgium, for example. This so-called staatsbond drew a lot of money from retail investors. Another trend that sort of pushes these retail market share is the emergence of user-friendly platforms and information channels that make it really easy for investors to sort of directly invest in markets. And then there are good statistics on this from the IMF, the French supervisor, which saying that especially young people are going en masse into capital markets. 38.5% of new equity investors were under the age of 35 in 2023, and more than 14% under 25. So young people are really discovering markets. And the instrument they're mainly doing this with is ETFs, exchange traded funds. We've seen in our statistics that ETFs have outsold other long-term usage funds in both 22 and 23, and we also see the same trend in 2024. So again, according to the IMF, 250,000 retail investors bought or sold ETFs in Q2 2024 in France. This was an 89% rise from the previous years. Also in other countries, this is increasing. Like in Germany, you have these ETF saving plans, which are drawing lots of inflows. But not just Germany, also Italy, Spain are they're doing very well. So yeah, massive inflows there into ETFs. In the institutional market, this of course is still growing. It just grew less this year and in recent years. Pension fund market share sort of stabilized, declined a little. This grew for a long time, but was pushed by this auto-enrollment pension scheme in the UK, which sort of matured, and then the market share stabilized. The share of insurers sort of dropped off a little. This was due to the stronger growth in equities also. That also plays a role, since insurers are more heavily invested in fixed income. And also to some development in Germany and France, where the growth of insurance clients was less pronounced than of other clients. Now let's look at the foreign and domestic clients. So here we look at like the assets asset managers manage, are they on behalf of foreign clients, so clients in a different country, or from domestic clients in the same country. If we aggregate this at the European level, we see a steady rise in foreign clients from about 29.7 to 32.6 in general. This is it's a good sign. It shows we are sort of moving towards the genuine European capital markets, one of the objectives of the whole CMU, European Commission initiative. Foreign clients are more prevalent in the mandates than in the funds. We see a sort of a difference there. That is because the main clients of mandates are institutional investors, and they often look abroad for investment opportunities. It's a very competitive market there, so it's easier to move to a different country there. In terms of which countries have the largest foreign clients, it's really the UK, with London still being this international fund management hub. But there, the share of foreign client has not increased a lot in recent years. So we do see increases in other domiciles, for example, Denmark and France, where we saw strong growth of foreign clients, meaning that they are developing as a European asset management hub, really, and drawing clients from all over Europe. This is all I wanted to say on the clients. It's now over to Hailen on the asset allocation.
Thank you, Thomas. Good morning, everyone. So in this section, I'm going to present the latest trends in asset allocation in Europe. Thank you. So this slide displays the asset allocation of European AUM and the key trends observed over the past years. By the end of 2023, bonds accounted for the largest share of assets managed in Europe. This reflects the importance of institutional clients who prefer bonds due to their nature as safe instruments that preserve capital and provide a stable income. Listed shares closely followed as the second largest asset class. Cash and money market instrument made up 6.4%. The rest, 25.6%, we labeled as other asset. The other category is quite diverse. It includes private equity, hedge funds, real estate, and other types of asset. What these alternative assets generally have in common is lower liquidity. Based on our estimate, 22% of this group is allocated to real estate, and 12% to private equity, and just 1% to hedge funds. The rest, 64%, cover other types of alternative investment strategies. In 2023, both the shares of equities and bonds in the portfolios of European asset managers increased. This is a result of increase in both stock and bond valuations. Shares of cash and other assets decreased accordingly. Market share for bonds increased more rapidly than equities in 2023. This was due to some factors. First, the bond funds was the top-selling fund category in 2023, attracting 144 billion euros of net inflows in the bond usage. Second, the asset managers adjusted their portfolios to bonds in anticipation of potential rate cuts in 2024. Third, the changes in the client preference also had an impact, as higher bond yields attracted renewed demand from pension funds and insurance companies, reducing their need to invest in less liquid alternative asset. Please move to next slide. Next slide. Thank you. This slide focuses on the rising trend of passive investing in Europe. Another key trend in the asset managers' allocation choices is the steady increase in the share of passive asset management. This shift accelerated notably in 2023, as the passive share jumped from 16.1% to 17%. This aligns with the rapid increase in ETFs, which are largely passive index tracking instrument. ETFs have become increasingly popular in recent years, particularly among households looking for cost-effective and diversified investment options. The continued cost difference between active and passive management is most likely the key reason behind this evolution. Please move to the next slide. This slide takes a closer look at the trends of domestic equity and bond holdings in European portfolios. Domestic equity refers to stocks issued in the same country as the asset manager. For example, in France, domestic equity would include the stocks issued by French companies that are held by French asset managers. In Italy, it would be Italian issued stocks held by Italian asset managers. Aggregated at the European level, domestic equity holdings of European asset managers gradually declined over the past years. This is due to the same trend as Vera explained earlier for the funding of the European economy. Stocks outside of the Europe, meaning the US, just performed better in recent years. However, the proportion of domestic equity largely differs across Europe and often higher in smaller countries. For example, the share of equity holdings is more than 50% in Turkey, Croatia, Greece, Poland, and the Czech Republic. There are a few reasons for this. First, asset managers in smaller countries often have competitive advantages in managing local stocks. Global asset managers may also not be always interested in selecting stocks from smaller companies in smaller countries due to the relatively lower demand for them. Second, a degree of home buyers can drive demand for local stocks, motivating local asset managers to focus on domestic equity funds. Third, additional factors such as regulatory constraint or exchange rate risks can also have an impact. For example, Turkey, where the high share of domestic equity has been affected by the high volatility of the Turkish lira in recent years. Moving on to the domestic bonds, asset managers generally hold a higher share of domestic bonds than domestic equity. This is largely because bonds tend to benefit from a stronger home buyers, especially among institutional investors. The share of domestic bonds increased sharply again in 2023, as higher yields once again made it attractive for asset managers across Europe to invest in domestically issued debt. Please move to the next one. In this slide, we focus on ESG asset holdings and SFDR Article 8 and Article 9 funds managed in different European countries. At the end of 2023, around 52% of fund assets managed in Europe applied some sort of ESG investment approach. In the mandate market, this percentage is much higher, about 64%. The difference between funds and mandate can be explained by the following reasons. Firstly, institutional investors, the principal client of mandate, often make strict ESG demands for the management of their asset. Secondly, in the fund market, ETFs and index tracking funds constitute a sizable segment. These funds mostly track indices composed of various stocks or bonds. Frequently, not all of the financial assets in such index can be considered as sustainable. The two charts in this slide illustrate management of SFDR Article 8 and Article 9 funds in different European countries. For Article 8 funds, France is the largest market. The Netherlands and Sweden come next, with notable shares as well. In most European countries, Article 8 funds mostly consist of a mix of long-term funds, such as equity, bond, and multi-asset funds. Management of Article 8 money market funds is primarily concentrated in France. For Article 9 funds, management is more concentrated. Switzerland leads the market, largely due to the dominant market share of a large asset manager specializing in thematic Article 9 funds. And France ranks in the second place. Thank you for your attention. I will now pass the floor to Thomas to continue.
Yes, thank you, Hélène. just a few words on sort of the organization of the European asset management industry. What we did also is look at market concentration in different countries. So on the left-hand side, left-hand chart, you see the market share of the top 5 asset managers in terms of total AUM, funds and mandates. For most countries, there are a few where we just had to look at the funds because we don't have the data. In terms of the total market. So obviously there is you get sort of this diagonal line, which smaller countries in terms of AUM have a higher market share of the top 5. The largest market in Europe has one of the lowest market share of the top 5. And there were some countries we couldn't include there, one of the real small ones in Europe, because they had the top 5 were the whole market. Yet there are some significant differences across countries of sort of similar market size. For example, Italy has a larger market in terms of AUM than Spain, but is significantly more concentrated, 86% market share of or 53% market share. So it all depends on how the domestic industry is structured and so on. Then we also looked at how this market share shifted over the past 5 years, because we're seeing a lot of reports, and that's undoubtedly true, that the market is growing more concentrated at the global level with the shifts to passive investing. And that's undoubtedly true. But if we look at the European countries specifically, the picture is a bit more mixed. The largest market in Europe, the UK, did see a small increase in market concentration. There are others that saw bigger growths, like Spain, for example. But this was due to large mergers and acquisitions between large asset managers, increasing this top 5 market share. A lot of the other big markets in Europe actually became slightly less concentrated. France, Germany, Italy, Sweden, they all became slightly less concentrated. This is a little puzzling, but we do have some potential explanations. Like, one explanation is that branches of larger global asset managers are gaining market share across Europe and then eating at the market share of these top 5 in some countries. Another reason is sort of the rise in popularity of ETFs, because the bulk of ETFs are not managed in European countries, they're managed outside the EU. And there, in that context, local asset managers sort of lost market share, and they're sort of falling back on their competitive where they have a competitive advantage for focusing on niche markets, domestic firms, SMEs, where economies of scale play less of a role. But undoubtedly, at the global and Europe level, we'll see an increase in concentration over the next years, because the operating profits in the industry, measured as basis points of average AUM, have been dropping in recent years. And they're actually, in 2023, they were only 11.1 basis points, which is a low not seen since the financial crisis of 2008. And this is due to a combination of revenue margins steadily declining. Why are revenue margins declining? Because of the sustained pressure on fund fees. This is increasing competition and driving down revenues. At the same time, cost margins have been increasing, especially in recent 2 years. Why have costs increased so much? A big factor there are technology costs. They rose sharply in recent years, driven by the ever-increasing investments that are needed in new data and technology to remain competitive, development of applications, building new infrastructures, data centers, and especially I wanted to flag out this market data cost. It more than doubled over the past 5 years from 0.4 to almost 1 billion. And this is the cost that asset manager need to spend on market data, which have cost of market data has soared way beyond inflation, but also increasingly on ESG data, where it's increasingly difficult to get good quality ESG data. So asset managers have to spend increasing amounts on this. So yeah, steadily declining profit margins this year, but we'll see what the future brings. This is the end of the presentation. We'll be now happy to answer some questions.
Yeah, thank you very much, Thomas, Vera, and Eileen. I don't see any question in the chat, but just you still have a few minutes just to think about questions. I'd like just to draw your attention to the fact that the report also is including a foreword by EFAMA President Sandro Pieri, the CEO of BNP Paribas Asset Management, into which Sandro is actually also stressing the decline in profit margins driven by this sustained pressure on fees and rising cost. So Sandro is just considering that the industry is navigating an area of profound transformation shaped by the geopolitical shift, the sustainability imperatives, and the demographic trends. And he hopes that measure will be taken to build a more competitive landscape industry in Europe, and also hopes that the creation of a European savings and investment union will convince more households to save in the capital market, in particular to build assets for their retirement. And of course, this trend would give more ammunition and asset to the industry just to invest into the real economy. And in this context, I'd like also just to highlight the fact that in this report, contrary to or other reports, we are including contributions from 3 firms of good reputation. This is just by invitation, and as in previous years, we have a contribution from McKinsey, which highlights the fact that there is a huge amount of retail asset that is not managed in Europe, because, as I said, many households are keeping their savings in bank accounts. So this is a missed opportunity for households. McKinsey is analyzing this trend, but also noticed that currently, based on Morningstar data, winners takes it all. So there is also a trend there in the market where only a small group of asset managers manage just to sell and manage funds for retail investors. And McKinsey is giving some explanation and recommendation to the industry to deal with that. We also have a contribution for the first time by Oliver Wyman on the opportunities that longevity, the increased longevity on the back of the population aging is offering for asset managers. But again, there is just an effort that needs to be made by the industry to create products that are indeed addressing the critical customer needs, in particular during the payout phase. And finally, we have a contribution by a firm called Novantigo, who is analyzing the business of asset management for insurance companies, giving some statistics about the demand for private assets, infrastructure debt, infrastructure equity, real estate, and private equity. And also, based on interviews, give a rating of the type of services the insurers wants, mostly from asset manager. Among those services, the top ranked are good financial reporting, strong risk management, and performance review. So with this contribution, I mean, our report is also intended to provide kind of more information, insight to the industry, just to keep performing better and increase efficiency in the coming years. So looking again at the chat, I see that there is a question regarding ESG data. There is no figures for Germany. This is highlighted, so can you explain why?
Yeah. I mean, the problem is indeed we rely on surveys run by our associate, our national members, and unfortunately it's a tricky data point to get data on at a aggregated level that's representative for the whole industry. So instead of showing a number we were not 100% certain of, we didn't show this number.
Okay, we just have a specific question, for instance, regarding the retail investment, the share of retail investors in the asset managed by the industry, and the question is whether these figures include the UK, and do you have separate number for the UK? Can you answer this question?
Yeah, we do. So the separate numbers are all in the report. In the UK, I have it here. It's about 27% retail market share, 73% institutional. On this retail rise of retail, I just wanted to say this is not just driven by one or two big countries. It's really across the board in Europe. We've seen 14 countries which saw the share of retail increase in 2023. So it's really a broad trend in Europe across countries.
There is also a question regarding the market data cost evolution. I think this is exhibit 5.7. Do we have a percentage of growth between 19 and 23? I think that this is provided, no, in this chart.
Yeah, the data is provided. It more than doubled from 0.4 billion to almost 1 billion.
It's a question regarding, what's going to happen in the near future regarding data cost as the number of providers grows and data quality improve. Do you expect cost to decrease? I mean, we are not really making this type of speculative projections. So, but certainly this is a source of concern. Because on the one hand, I mean, there is this huge pressure on fees. There is a huge demand from regulators to offer, kind of so-called simple, low-cost investment product. But on the other hand, there is a number of, cost item that tends to increase. This is true in the area of data. So, you know, I think we would need just to be optimistic to think that this cost item would decrease. Do we have any breakdown of investment between different type of bonds?
This is something we are trying to work on in the fund market, and this breakdown by type of funds, corporate, government, high yield. But in this report, we don't have this data, unfortunately.
Okay, and what about data on sustainable product and investment? What do you expect for the future? I think that Thomas, you're working also on a market insight on this. Could you give us kind of a glimpse of your findings in this area?
Yes. So I mean, what we've seen in recent quarters, recent months, is actually outflows from Article 9 funds. So the darker green, the funds with a sustainability objective. So that is a little worrying for those type of products. But I think there is an overall view, and I'm not saying something new here, that the SFDR, with these de facto labels of Article 8, Article 9, isn't really working. So I know the Commission is planning an SFDR review, and we might try to get rid of these de facto labels that aren't really designed as labels, and we should move to some sort of a real product label. And EFAMA is developing a position there, and I think an important focus should be given on transitioning assets, because at the moment that's not taken into account at all.
Okay, thanks a lot. So I think we are approaching the end of this webinar. I'd just like to mention that the report has 74 pages. So what you have got today as a presentation is really a highlight of the key findings. It's a rather long report, and my understanding also is that this webinar is recorded. So with these remarks, I would like to thank you very much for attending the webinar. The AMR will be published on EFAMA website later this morning. And should you have any additional questions or even suggestions about what is missing and should be part of next year's report, you know, please do not hesitate to contact us. And before closing, I'd like to take this opportunity to wish you a wonderful end of the year and all the best for the year ahead. Thank you very much. Take care.
Thank you very much.
Thank you.